Warning signs are flashing, and they're coming from a place many Americans know well: Home Depot. What at first looks like just another corporate earnings report is actually a powerful signal about the state of the U.S. economy. Beneath the surface of falling sales and cautious corporate language lies a deeper story about how American consumers are pulling back, how the housing market is wobbling, and how the ripple effects could hit every corner of the economy. So tonight, we're going to dive into what's happening inside Home Depot, why it matters, and what it tells us about the road ahead for the United States. The starting point here is Home Depot's latest earnings update. On the surface, it doesn't sound catastrophic. Earnings per share only slightly missed expectations. Revenue is still growing compared to a year ago, and the company even maintained its full-year guidance. But the details are where the real alarm bells start ringing. Home Depot's chief financial officer admitted that while people are still coming into stores, they are holding off on the big-ticket projects, the kitchen remodels, the bathroom upgrades, the large-scale renovations. Customers aren't canceling outright, but they're deferring, waiting, hoping for a better time. And in economics, delays often mean something more profound: a lack of confidence. The official explanation points to interest rates. With borrowing costs elevated, financing those bigger projects feels more burdensome, and so families hesitate. It's easy to point to the Federal Reserve's rate hikes and say, that's the reason. After all, history shows a clear pattern. Every cycle of aggressive rate hikes has been followed by a slowdown in retail sales. Put up a chart comparing the federal funds rate with real retail sales, and the correlation becomes obvious. When the Fed tightens, consumers tighten too. That's the textbook story. But here's the uncomfortable truth. It's not just about rates. If it were only about rates, the solution would be simple. The Fed cuts, borrowing costs come down, and spending revives. But we've already seen instances where modest cuts didn't reignite demand. The real driver is the labor market. It's about wages, hours worked, and the sense of job security. When Americans feel uncertain about their paychecks, they don't spend big, even if interest rates drop a little. Home Depot's own executives hinted at this when they said projects are on hold. That hesitation reflects more than just math on a loan calculator. It reflects anxiety about the future. Consumers might still buy small items, plants for the yard, light fixtures, or tools. But the big-ticket discretionary spending is where you see the pullback. And that's dangerous for Home Depot, because their profits depend heavily on those larger projects. Selling a hammer or a set of garden gloves doesn't drive the bottom line the way a full kitchen renovation does. When consumers retreat from those larger commitments, it's not just Home Depot that suffers. It's contractors, suppliers, manufacturers, and the entire chain of industries tied to home improvement and housing. This is why Home Depot's cautious language should be seen as a warning for the entire U.S. economy. Because it's not just about home improvement projects, it's about how Americans are handling their finances in the face of shrinking real wages. Inflation-adjusted paychecks haven't kept up with rising prices. Even when companies try to hold the line, tariffs and supply chain costs eventually force them to consider raising prices. Home Depot sources over half its products domestically, but the remainder is exposed to tariffs and global cost pressures. The company has quietly acknowledged it may need to nudge prices higher in certain categories. But here's the catch. American consumers are already stretched. They're pushing back. History shows that when companies try to raise prices into an inflation-weary consumer base, it leads not to higher revenues, but to margin compression. In the 1970s, 1980s, and 1990s, every time inflation spiked while wages lagged, corporate profits took a hit. Consumers simply stopped buying. And yet, the stock market sits at all-time highs. Investors are demanding growth. Wall Street wants companies to keep delivering earnings that beat expectations. That pressure doesn't go away, even when households are tapped out. So companies are caught in a bind, raise prices and risk losing customers, or hold the line and watch profits shrink. Home Depot's strategy is to carefully test where it can increase prices without provoking backlash. That might sound clever, but it's also risky. Because if customers are already putting off projects, sneaking in price hikes won't fix the core problem. It could make it worse. Let's zoom out to the broader housing market, because this is where the ripple effects become crystal clear. Housing starts recently rose, led by multifamily units. At first glance, that sounds like a positive. But the reality is more complicated. Across parts of the U.S., especially states like Florida, multifamily construction has been running hot for years. Developers may be adding supply that isn't matched by demand. Overbuilding leads to empty units, weak rental markets, and eventually financial strain on builders. Meanwhile, single-family home construction has slowed to the weakest pace since early 2021. That slowdown reflects the same story as Home Depot's customers. Buyers are hesitant. High mortgage rates make monthly payments daunting, and job insecurity makes long-term commitments frightening. Builders are responding by cutting back on speculative homes, those built without a buyer already lined up. They know inventories are swelling. In fact, new home inventories are now the highest since 2007, the very year before the housing crash that triggered the global financial crisis. When supply outpaces demand, prices inevitably soften. Builders try to offer incentives, discounts, and upgrades to lure buyers. But when consumer confidence erodes, discounts can only go so far. This is why residential construction has been a drag on GDP for most of the past 5 quarters. Here's the dangerous feedback loop. Fewer home sales mean fewer home improvement projects, which means less revenue for Home Depot and its peers. As builders scale back, construction jobs dry up. That pushes unemployment claims higher. You can chart this relationship over decades. Housing starts fall, continued jobless claims rise. It doesn't happen instantly, but the pattern is consistent, leading into every recession. And we're seeing the same signals today. Continued unemployment claims bottomed out around 2022, right as housing starts peaked. Since then, starts have trended down, and it's only a matter of time before job losses accelerate. So when Home Depot warns that big projects are on hold, they're really pointing to something larger: the fragile state of the U.S. labor market. Consumers aren't spending less because interest rates are half a percentage point too high. They're spending less because they're worried about their jobs, their wages, and their future. Surveys confirm this. Americans increasingly report anxiety about losing their jobs and skepticism about finding new ones if they do. That fear translates directly into spending decisions. The data backs this up. Real retail sales track closely not just with interest rates, but with average weekly hours worked. As hours decline, retail sales follow. Since 2022, weekly hours in key sectors have drifted lower, and retail spending has mirrored the fall. It's not about the Fed's next move. It's about paychecks. Without stronger wage growth and more secure employment, rate cuts won't spark a spending surge. That's why the Fed can cut by 50 basis points and see no meaningful improvement. The problem is deeper. Meanwhile, the housing sector shows more cracks. Home prices, which had held up surprisingly well, are starting to slip in some markets as sellers outnumber buyers by the widest margin in more than a decade. Redfin data shows nearly 1.92 million sellers compared to just 1.41 million buyers, a mismatch of over 500,000. That's pressure that eventually forces prices down, hurting household wealth and discouraging spending even further. And once again, it circles back to Home Depot. When people aren't buying new homes, they often improve the ones they already own. But when they're too nervous to even invest in renovations, it means the cycle has shifted from healthy hesitation to outright contraction. To make matters worse, stress is building in the real estate finance world. Private funds have started gating redemptions, echoing the early panic of March 2020. When investors try to pull their money and funds refuse, it's a sign of deep concern about falling property values. And commercial real estate, already under immense strain, threatens to trigger wider financial contagion. If values plunge, lenders tighten, and construction halts. The ripple effects hit retailers, suppliers, and ultimately employment. This is why Home Depot's situation isn't just a company story, it's an economic signal. A company that thrives when Americans feel secure enough to invest in their homes is telling us those same Americans are holding back. It's not just about this quarter's numbers, it's about the trajectory of confidence, wages, and jobs. When Home Depot hints at raising prices, they're acknowledging the squeeze on margins. When they report large projects are on hold, they're confirming the anxiety that surveys and data already show. And when they try to frame it as an interest rate story, they're missing the bigger truth. It's a labor market story. So, what does this mean for the future? It suggests that the U.S. economy is heading into a phase where consumer spending decelerates further, housing weakens, and corporate profits come under strain. Investors betting on endless stock market highs may be in for a shock. Because while Wall Street still expects growth, Main Street is signaling caution. And history shows that when these two diverge, reality eventually catches up to the markets. This doesn't mean a collapse is inevitable tomorrow, but it does mean that the warning signs are piling up. Home Depot is just one voice, but it echoes what we're seeing in housing data, labor surveys, and retail spending trends. If Americans don't feel secure in their jobs, no amount of rate cuts will push them back into big spending. And if builders keep cutting back, inventories keep rising, and sellers keep outnumbering buyers, the pressure will build until the dam breaks. That's why Home Depot's latest report should not be shrugged off as routine corporate news. It's a canary in the coal mine, a signal that the U.S. consumer, long the backbone of economic growth, is retreating. And when the consumer retreats, the entire economy feels it. So as we look ahead, pay close attention not just to what the Fed does, but to what companies like Home Depot are saying. Because beneath their cautious words lies the story of where the economy is really heading. Americans are holding back, builders are scaling down, and investors are starting to worry. The cracks are widening. The question is, how long before they become fractures? And that's where we leave it tonight. The warning from Home Depot isn't just about home improvement. It's about the broader American economy, the pressures on families, and the risks that lie ahead. If history is any guide, ignoring these signals has never ended well. The time to pay attention is now, before hesitation turns into crisis. Thanks for watching. If you found this analysis helpful, make sure you stay tuned for our upcoming breakdowns on the housing market, consumer spending, and the next moves from the Fed. The storm clouds are gathering, and the more we understand the signals, the better prepared we'll all be.